Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne, man with David Ingles.
Good morning. Let's get to your top stories today. Stocks across the Asia Pacific in the green, up for a sixth straight session here. That's as U.S. and European Union near a trade deal that could actually set tariff rates at 15%.
Meanwhile, Chinese President Xi Jinping set to host EU officials led by Ursula von der Leyen amid lingering disagreements over export controls and China's ties with Russia.
And we're looking at shares of Tesla in the after-hour session down quite a bit. In fact, here, sales slump. You have Elon Musk warning of a few rough quarters ahead. Right, welcome to the show. A quick glance at market action. And as we were just pointing out a few seconds ago, a sixth straight day of gains. We're now at the highest level in about 4 years in the MSCI benchmark here for the Asia Pacific. Longest streak of gains going back to the very start of the year. Nikkei 225, as you can see on your screens, is now within, and the Topix index is already there, now within about 1% of hitting a fresh record as far as that's concerned. AI trade back in focus. You have, of course, SK-Hynix within that story. In fact, flip the page, please, and have a look at how we're doing on those specific stocks. Given the earnings beat, 68%, I believe, record profit, AI spending, 3% on the Hynix and SK-Hynix. TSMC is coming online, and some of the other iterations of the AI trade in the Asia Pacific, with the exception of Disco, as you can see, which is like dancing slightly lower. Most are actually on the up. Kospi index up a further 1%, one of the best performing markets globally, even more so today. Currency markets, we have an ECB decision. Don't forget, later on today, more on that in a moment. A weak dollar story, roughly, as far as some of the other Asian FX is concerned. 146 now, or closer to 146 on the yen. We haven't had a 714 handle for the Chinese currency in a while. In fact, that's now at about an 8-month high as far as the Chinese currency. 7-month high, thank you so much, is concerned. Very quickly, going into the open today, and for once, we are looking at a sideways open, and just really coming off what's been a manic last few days for Chinese equity markets. 4-year highs, more on that in a moment. Turnover 1.8 trillion for a second straight session.
The animal spirits are back, not just in China, as you take a look at the milestones, as you mentioned, but 4-year highs for all these gauges in Hong Kong,
yeah.
A CSI 300 as well, 8-month highs as well, and even seeing Chinese long bonds sell off and really joining this sort of route in global bonds as well. So certainly, is this sort of the way to go, given that we're getting more and more of these trade deals, there's more optimism around that, or are we still complacent about the fact that a lot of these effective tariff rates are actually higher than 10%, which was what the best case scenario used to be? So is that all going to start to bite at the end of the road? Yeah,
I guess it depends on the comparison, right?
Yeah.
So relative. It's certainly hard at 10%. Markets seem to be moving along the narratives that at least we're not getting the worst case scenario of another back and forth on retaliatory tariffs from both sides. All that being said, we'll see what happens between the U.S. and the EU, between EU and China, of course, one of the big things, of course, today. And, of course, coming up here on shows, a lot of guests coming through to talk us through this manic rally we're seeing in equity markets here in Greater China, number one. Number two is, of course, the earnings that have come through. There's Tesla, there's been Alphabet, of course, to talk us through. NVIDIA's at 174 trillion. Beth Kindig joins us to talk about that. ETFs. Greater Chinese markets. Chinix index has done well, and of course, eFunds has released a new product this week. More on that in a moment, and of course, more as well on these conversations. President Xi Jinping, of course, is set to meet EU officials, not in Europe, they're in Beijing. More on that in a moment. Right. On the recent trade deals we've seen this week, you had the Philippines, of course, did strike a trade deal with the United States, agreeing to a 19% tariff rate on its exports to the U.S. Now, that announcement came as President Marcos visited the White House. For more on the deal and its impact, let's head over to Washington now and, in fact, bring in the Philippine ambassador to the United States, Jose Manuel Romualdez, joining us right now. Ambassador, good morning from the Asia Pacific. Thank you so much for staying up and joining us today. Lots to talk about. Just your initial, what do you think the key takeaways are from this trip, apart from obviously what's been taking place along the trade lines?
Well, good morning to you, David and Yvonne. Yes, essentially, I think on overall, we found the meeting with between President Trump and President Marcos to be sort of like a good meeting. And not only that, I think there's a connection there, which is very important. I think we all know with President Trump, he always believes in a personal relationship with any leader of any nation. And I think that President Marcos and President Trump kind of hit it off very well. So having said that, there are many aspects of our relationship. It's not only economic. Obviously, there's our a very important defense alliance with the United States, which is obviously a key factor in our relationship right now. And also, of course, the people-to-people ties that we have. We have 4.3 million Filipino Americans living in the United States, and I think we have about 700,000 Americans living in the Philippines. So with that, I think overall, as I said, it was a very good, I would say, an excellent opportunity for the two leaders to be able to get to know each other well. They have known each other even before President Trump became president, but this time, as both leaders of their countries, I think it's a good start.
Yeah, Ambassador, a lot of attention, and understandably so, has been put on 1 percentage point drop from 20 to 19%, and some of the critics, I'd like to hear your thoughts on it, have said that President Bongbong didn't really achieve very much as far as bringing down that specific tariff. What's the response from the government?
Well, I think that it's not. I would say that is a start. There's still time for us to be able to get some more details on how we can manage to bring it perhaps a little much lower than that. We're still looking at the possibility, but also the details on the no tariff for any imports coming to the Philippines. We're still looking at. There are so many details that were not discussed. So the discussion with President Trump and President Marcos was mostly on the overall picture of on the tariff, but nothing came on the details, and that'll have to be discussed by our negotiators.
So 19% might not be final, Ambassador. I'm just wondering what's the ideal situation? How low do you think Philippines can go, or is at least aiming for, in order to stay competitive with other ASEAN nations?
Well, there was an announcement that came out of the White House today. I think that I think President Trump said that the lowest he will go is 15%. So obviously, all countries are going to try to get to that point, the 15% tariff. So obviously, we'd like to see that happen to our trade agreement with the United States. Japan, I think, got the 15% tariff rate, and that's because they have a $600 billion commitment to invest in the United States. So we don't have anything like that. But just nonetheless, we're still looking at the possibility of bringing that lower, since we still have time to negotiate this.
Ambassador, one of the other key components of this relationship, which you've highlighted, we heard it from President Trump as well, the Philippines is a key military partner. To that extent, could you maybe shed some light and more color on what was announced? Were there any new security guarantees or support that the U.S. has extended to the Philippines?
Well, I think what was discussed openly at the Oval Office was the fact that the U.S. Congress had approved from their NDA, the National Defense Act, that they will be setting up an industrial base of the manufacture of ammunition in the Philippines, and that is a sort of like a joint venture. That is a very good what do you call this, a template that we would like to see, where we can have the manufacture of defense material, and it'll create jobs obviously in the Philippines, and that's one way that's an investment's coming into the country. That's one particular area where I think we had some discussions on that one, and I think that both President Marcos and President Trump see that as an opportunity once again to strengthen not only our defense relationship, but also our economic relationship.
Yeah, I believe that, correct me if I'm wrong, I believe that project is being eyed in Subic of course, back in the Philippines. I'm wondering, do you have any more details on that you could share? Any timelines that were talked about as far as that specific sort of exercise is concerned?
I think that we have some companies in the Philippines that already are in that business, and so they're actually in discussion with some of the companies here in the United States that are also in that kind of business also. So we're looking at potential joint ventures or possibly an investment coming directly from the United States government. We'll see what happens. It's still too early to be able to tell you any more than what we already know, which is basically that there is an intention to set it up around the Subic area.
Understood. And maybe just one last, maybe on defense here, and maybe just to put to bed as well, speculation. Was there or is there any material conversation around officially returning military bases to the Philippines, U.S. military bases to the Philippines?
No, there was none. Mainly because it is clear, and we made it clear to our friends here in the United States, that it's now in our constitution that we will not allow bases, foreign bases, to be established in the Philippines. It is now in the constitution of the Philippines.
Ambassador, I want to get back to sort of some of the details of this trade agreement, where Marcos did mention that zero tariffs on U.S. exports to the Philippines will apply only to certain products like automobiles. Can you give us a bit more? Are there other sort of products or items that you look at besides automobiles now?
Well, I think there are quite a number of things that are being manufactured here in the United States that we do not have in the Philippines. I can't specify any more than, of course, automobiles and auto parts, and I think there are other things, manufacturing, what you call the machinery that we could probably import. We need to start looking into modernizing some of our manufacturing plants. There are many items. There's a long list of items that I think that could really bump up our trade between the Philippines and the United States. So we'll see what happens. As I said, it's still being worked out. The details are still being worked out by our trade negotiators.
Was there ever a discussion about rules of origin or transshipment concerns, Ambassador? Because there has been some concerns that, there could be some goods that are coming from China, for example, through Southeast Asian nations, which we have seen in that Vietnam deal with the U.S. as well. I'm just wondering, were those discussions ever made?
Well, we assured, we don't have any of that. There's no transshipment coming through the Philippines, and that's the reason why our trade is somewhere between 4.8 to 5 billion. So there's absolutely no transshipment that's being done in the Philippines right now.
Ambassador, final question: Did we miss out on anything? What else do you think is pertinent that we need to know?
Well, I think what's important, again, like I said, is that as far as the trade deal is concerned, we all know that there's always room for negotiation, like what happened with Japan, and what's probably happening to the other ASEAN countries. And the reason why we came down to the 19% is because that's only what, as President Trump pointed out, that is the base for the Asian countries right now. That is the lowest. But there is room for more improvement on the tariff, as he announced earlier today, that the lowest he'll go is 15%. And so we're all hoping that we'll be able to bring it down to that level.
What a new normal, isn't it, Ambassador? Thank you so much for the time and staying up, of course. And we know it's been an extremely busy few days for you and your team. Ambassador Jose Manuel Romualdez there, the Philippine ambassador to the United States, joining us there out of Washington. Right, going into the Open today, just 15 minutes away, 16 give or take. It's, 10 out of 10. That's the morning so far. You're seeing here in Hong Kong. Fantastic weather. The sun is out finally. Futures are flat. Anyway, you can have everything, right? This is the China Show.
All All right, your agenda here today, of course, that China-EU summit is certainly one thing. High-level talks between Xi and Ursula von der Leyen. Certainly that coincides with the EU and U.S. trade talks that are also undergoing as well. So how does that factor into what's going to be happening in this summit this time around? That stocks rally, which we talked about here as well, certainly one to watch is the EV sector. There's been elderly stocks as well. We've been focusing on that. And now there's some data coming through here, whether it's Macau visitor arrivals. There's a CGB sale, interesting enough, at a time when we actually are seeing a bit of a bond sell-off in the long end. And yeah, we also have that July economic survey too that's coming out later on today.
Yep, at some point this morning. Right now, though, that's something that's coming up is the fix of the day, and we haven't had a 713 handle on this in a while. In fact, the strongest fixing since November of last year, 713.85 to be more specific. That really goes into maybe this rally that's taking place. Yvonne and I have talked about this turnover, second day, 1.8 trillion onshore. Effectively where we are. So if you ask us, okay, where exactly is this rally that's coming up on your screens very shortly? 4-year highs, not this, the other graphic, please, if we can. 4-year highs on, there, thank you so much. Hang Seng China, Shanghai Comps 2021, I believe, 2022 highs, and CSI 300 back to about 8-month highs. Just a gauge of momentum on the right side of your screen.
Yeah, so things are looking a bit maybe overheated, right? If you take a look at how these RS are concerns right now. Let's bring Winnie Wu, China equity strategist of BofA Securities. You've been just coming back from this whole financial tour. A lot of it is the amount of southbound flows alike. I mean, how far do you think this sort of flow buying can go?
Yeah, I mean, I think the flow buying can go as long as one is the overall rate and bond yield environment remains low. So whether it's insurers, asset managers, pensions, or even retail depositors, they are seeking for yield, for return, and high dividend yield SOE banks looks like a good alternative. You know, for them, it's almost a sovereign credit, and banks have relatively stable dividend yield, right? And two, I think, you know, the chase for yield might continue as long as people have low expectation on growth or better themes, right? So, you know, if people have more higher conviction on stimulus, on growth, they will be chasing these growthier stocks, right? In the past few days, we saw the growth, the people chasing like commodities, 2 weeks ago, property. Yeah. But if those themes comes and go rather than sustain, then money go back to the defensive, to the yield stocks. And I think generally people now have relatively low expectation on policy stimulus, have low conviction on the growth names, right? So these defensive yield names remain popular. And also what we observed is for some financial institutions, they buying these banks, for example, in gaining a board seat so that they can do equity accounting. So when they bought at 0.5 times PB, getting the board seat, equity accounting, they can say, oh, I'm carrying it at 1-time book. So suddenly there is a massive accounting gain, which a number of institutions already booked in the past. So that's an additional layer of motivation incentive. We see distressed asset managers, some insurers, and going forward, potentially some corporate want to play this game. So what's the end game ultimately, right? Not that I'm supportive of this thesis, but the end game here could be let's trade the banks all the way up to 1-time book. So that this equity accounting game no longer makes sense, so that the yield goes down to like less than 2.5%, close enough to the government bond yield, then maybe that's the end game. But as of now, I think, you know, the pain trade continues, and, you know, the fact that the financials generated a strong absolute return, right? Previous years, banks outperformed, but it was relative to China market. This year, the China financials actually is absolute outperform even in the emerging market or the global context. Then it actually also attracted more investors who previously or historically underweighted these China banks, now need to take another look and re-examine and to some extent participate in the pain trade.
What's ironic about this, the more people that chase this trade and the better it gets, the lower the yield eventually gets, right? Are we at that inflection point now? Are we close to that inflection point?
So interestingly, on this tour, when our investors met with the insurers, like 1/3 or even half of the question on the insurers were about their investment strategy. It's like, are
not
you buying
the business
more
strategy.
No,
okay.
Not the premium growth, not the first, not the VNB margin. No, but it's like, are you buying more banks? Are you buying smaller banks other than the SOE banks? Are you seeking to get a board seat? What's the lowest acceptable yield you can take, right? So that is actually a key question, because for the H-share banks, on average, for example, in September last year, the average yield was still 8%. Now it's down to 5%. And for some A-share banks, the yield is like have a 3 handle, right? It's 3.1%. The bar has keep moving lower. That's why a lot of investors are asking, hey, how far this can go?
Right.
And that's why I say the end game is 1x PB, yield goes to like 2.1%.
Yeah, I mean, 10-year yields at half of 1%, right?
Yeah.
So there we go. We'll have more from Winnie Wu in a moment, China equity strategist at BofA Securities. We're talking anti-involution, full report out, plus other themes across these markets. Going into the open today, time is it. Okay, under 7 minutes away, flat open. This is Bloomberg. Right, welcome back to shows. Pre-markets looking like this. So finally some consolidation after really what's been a decent run recently. Hang Seng Tech is just within a couple of percentage points from that high we hit very recently. We have topped those highs on the Hang Seng China and Hang Seng Index. As you can see, we haven't been at 25.5 in a while. And some strength coming through in the Chinese currency following the strongest fix going back to November of last year. The exchange rate itself is at about those levels as well.
Yeah, in terms of stocks to watch, we're watching the Chinese EV sector here. This is on the back of what we heard from regulators issuing some sort of ethical guidelines for automated driving tech. So this is on the back of what we've heard from this fatal accident involving an autonomous Xiaomi vehicle recently. So certainly we are seeing some of these EV stocks lower this morning. NIO's down some 2%. And Tesla, right? So what we heard from Elon Musk saying that there's going to be some rough quarters ahead. We talk about what I'm talking about. Is this an automaker? Is this an AI and robotics sort of company now? It really depends on how you view this stock. But you're seeing some of the suppliers actually rallying. CATL 8 shares are up some 1%. The open is next. This is Bloomberg.
Good morning. Welcome back to shows. Yeah, we made it. We made it through hump day. It's a day away from the weekend. It's quiet across these markets. We're still watching out for a lot of things on the Chinese front. Most front of which, of course, will be this summit taking place today at the Chinese capital. And we understand, of course, President Xi Jinping is set to meet top EU officials, and let's see what they are able to come out with as far as that's concerned. In fact, later on in the show, we'll talk more about this with some guests coming through as well. But yeah, apart from that, it's quiet, Yvonne.
It is, but it certainly gives us time to look at some of the big themes out there. Yeah. And, we're hearing from President Trump about this sort of, I guess, framework of what these tariffs are going to look like, right? It looks like it's 15% to 50% is what these countries might get, whether it's from these trade talks or in the form of a letter. But 15% seems to be the new 10% that we have to deal with in this new tariff world.
Well, the new zero.
So certainly that is the new thing to watch out for here in the coming days and months as we get closer to this August 1st deadline, August 12th for China. As you say, it's quite quiet, but certainly we've hit some pretty key milestones when it comes to these Chinese equity markets, whether it's onshore or offshore, right? You take a look at how CSI 300, we're talking about 8-month highs. Shanghai Composite, we're at 3-year highs right now and ever getting closer to that 3,600 level for Shanghai. So certainly that's one to watch. And we're watching, of course, what's happening even in the bond space in China, which we've talked about, low rates for some time. But now we're starting to see the sell-off, particularly in the long end, pick up. In fact, we're seeing maybe a 6-day or 7th day now where that 30-year yield is going to be slightly higher. So maybe we're finally joining this sort of route that we're seeing in the long rate side of things in China as well. Why? Well, you talk about animal spirits coming back in the equity market, this whole kind of anti-involution theme. Maybe this means the economy can escape deflation. That certainly is what markets are starting to reprice here right now, right? Whether that is going to be a multi-month, multi-year story. We're going to talk to Winnie Wu from BofA on that as well. But you take a look at how commodities are doing. We're actually on offer on some things like copper, steel, and iron ore after what we've seen is quite a tremendous rally of some of these commodities of late here. Shanghai crude is slightly higher. We talk about Tesla. Not sure if that's really what's driving some of these Tesla suppliers like CATL here today. The tech space has been on fire here, really, and what's led to this rally as well. Flip of the boards, we'll see what Hong Kong is doing here. We talk about the fix as well. That was quite a strong fix on the PBOC here once again. Hong Kong's doing this, so we're a little bit better there. There you go. We're upside about 1/5 of 1%. But what we saw yesterday was the 8-share gauge that we're watching very closely, right? We're at 9,250 and change now. That brings us back to the highest levels we've seen since October of 2021. So you got the IPO pipeline that's been very strong. Tech certainly is what's been driving a lot of that as well. In terms of honky dollar, still a little bit on the weaker side. We're at 784.97 here, but tech seems to be doing okay. Okay, right? Tencent, Alibaba are slightly up. Baidu, though, that's the one that's actually heading lower. We're down about 2.5% or more here this morning. So certainly one to watch here is the EV space. So we talked about some of these ethical guidelines that have been set here. So we're seeing a mixed picture across some of the EV space here this morning. And Tesla suppliers, we mentioned about CATL. Let's see how the 8 shares are doing here this morning. But yeah, what we heard from Elon Musk was a couple rough patches ahead. If you take a look at how shipments and deliveries are looking like here right now, CATL 8 shares are slightly down about 0.7%, Dave.
Yeah, he sees, a couple of rough quarters ahead. Beth Kindig, in fact, will be joining us later on the show to talk us through, of course, the tech side of this conversation. Is it a vision problem or is it an execution problem as far as Tesla goes? Shares are obviously off lows that we saw back in April, but we're still, I think, down about 18%. Now, the other conversation we want to talk about, too, as Yvonne was just alluding to there, right? So it's actually been, I just had to look, it's actually been 10 years since the last major initiative on supply-side reform, right? Top panel is industrial profits. Bottom panel is PPI. 2012 to 2015, wholesale price deflation. You had supply-side reforms, which to some extent, of course, worked back then. The world was also a very different place. And then as we get into this, the newest iteration of supply-side reform, anti-involution, the question is, will it work this time? And in which sector should we expect it to work this time? Winnie Wu joins us still, China equity strategist at BofA Securities. Why don't we start with that question?
Yeah,
you guys
sure.
put out a full report on that.
Thank you. Yeah, we just published a joint report this morning. I think, a lot of people compare to the current anti-involution to the supply-side reform 10 years ago. 10 years ago, it was very successful and was a pretty quick reaction from, the PPI turnaround from 5 years of deflation to pretty positive territory in 2017. Economy turnaround, corporate profit turnaround, and stock prices in the coal and the material sector basically more than doubled in the 2-year horizon. So many investors look at the old playbook and say, okay, let's buy these stocks. We see recently share prices up like 30, 50% in a month or so in some of these sectors. However, we want to highlight this time has a few quite important differences compared to 10 years ago. The first thing is the sector focus is different. Right. So 10 years ago, it was mainly old economy, SOE-dominated old capacity, which has been loss-making some of them being loss-making for years, right? We're talking about old economy, metal and mining, cement, steel, aluminum. But this time, many of the new economy sector, right, advanced manufacturing, strategic new sector, green energy, renewable energy sector also have this overcapacity issue. And many of the capacity were actually newly built up. And some of the technologies are commodities. So it's very hard to say, old technology, high energy consumption, high pollution, using those old standards to draw the line to say who are the winner and losers. Right. Right. Also, many of these new capacity were subsidized by local government, were supported by your Chinese bank sectors. So the pushback will be much higher, and many of them are actually now in downstream with more private sector company. Many also were able to export. So as long as Chinese export were okay, pushback from the industry will be strong. We are still bringing in FX reserves. We can still sell to the rest of the world. Why you want to shut us down? Right? So that's the first difference in terms of execution-wise. There will probably be much more pushback because it's more POE, private sector company, it's more new economy, and the capacity are fairly new. The second difference was 2015-16, supply-side reform happened, but there were also demand-side recoveries, right? China launched this Shantytown project. Property market had a big rebound in 2016. 2017 was global synchronized recovery, so export had a very nice rebound. So, this time the macro cycle might be quite different. Can we still count on export and property, or will there be new infrastructure that's driving the demand? It's still unknown. And finally, this time in anti-involution, we feel like it's much broader focus. So supply reduction is only one piece of the story, but there's also more focuses in terms of protecting SMEs on the supply chain. So like whether it's the auto companies, they shouldn't be squeezing the dealers for, putting the very high inventory burden on them, or they need to accelerate payment to the component suppliers. And then for e-commerce internet platforms, is about, you can't pass on the competition pressure to the SME merchant on your platform, and you need to step up the support for your delivery riders. So these policies are actually negative, marginally negative for the listed company, the large cap companies, but more in supporting the whole ecosystem and supply chain. Okay. And finally, I think this time there's also a focus on reducing the local government subsidies and support, right, which created a lot of repetitive competition. So when President Xi emphasized on building a unified national market, is partly also that to ring in the local government behavior and subsidies, which also caused a lot of geopolitical tensions and criticisms. So again, ringing in the government subsidy will probably be negative rather than positive.
So what you're saying, I guess, is it's early stages, manage your expectations.
Yes.
In terms of how I can trade on this, right? I mean, markets are kind of going with it anyways, right?
They have already.
They already have
already.
Yeah.
If where can I actually realistically then see better pricing, better margins, and better valuations on the back of this theme?
Our analysts generally have low expectation, right? Because a few things. One is the overcapacity in some sectors like solar, like cement, are substantial. But the current cut discussed was very marginal. And in most sectors, like for example, in steel sector, in the solar glass sector, we're talking about production cut, not capacity reduction. And production cut is only temporary. Right? It's not fundamentally addressing the supply-demand imbalances. So generally speaking, I would say, the SOE-related sectors like the cement, the steels, potentially will see some more real impact because it's easier to execute. And the sectors that's already having very low margin, low utilization, again, will be easier to implement. Whereas for like the solar equipment, the modules, the lithiums, some of the EV sector, it will probably be much harder to see it coming through in the near term. And even now, we don't have a concrete target for many of these sectors in terms of how much to cut or even how much to suspend production.
So what then is the earnings outlook?
The earnings outlook, from beginning of year, we saw in sectors like solar, lithium, chemicals, market factoring big earnings turnaround this year on the hopes of supply reduction, which hasn't coming in the first half this year. So I still worry that in the sectors that still rely on policy or policy implementation, there's potential downside disappointment. Whereas when we talk to others, for example, financials like like banks, insurers, it looks like second quarter earning will be marginally better, partly because of the equity market doing well, bond yield was going down, so there's better trading gains, and the second quarter economy was okay. So, I think different sector varies, but generally the sectors that were market already priced in high expectation for the supply side reform are likely to be disappointed for the coming couple of quarters.
A quick last question for you. Why has the Asia market been seeing this revival recently? I mean, turnover's picked up, Shanghai comps at 2021. I'm just wondering if we're overthinking that. Is something else going on there?
Yeah, I mean, to some extent, A-share was a big laggard this year, right? Even since September last year, H-share was one of the best performing market globally. A-share lagged. So I think people are looking at some of the AH spread, right, and seeing whether there is a reversal trend to play out. I think there are some, market chatters about whether southbound insurers keep buying H-share is healthy. Should they focus more on the A-share? But also, in May 20th, the major banks did a round of deposit rate cut. So 1-year rate was cut by 15 basis points, 3-year time deposit rate cut by 25 basis points. So after the rate cut, I think retail depositors are also looking at the savings, right? Your saving yield you 1%, and is it better off to buy the dividend stocks or buy the equity, which will give you 1% in a day, right? So I think it's a combination of these factors, mainly more on the flow as well.
Winnie, it's great to have you. Winnie Wu there, China equity strategist at BofA Securities. Coming up, we're going to take a closer look at Tesla, which is warning of a rough few quarters ahead, battling slowing sales in the U.S. and regulatory issues in China. This is Bloomberg.
Right, welcome back for the already, I think, 4th time. We're looking at Tesla suppliers. Nothing much to see here. It's just to show and say that Tesla is a big story today. You like how we crowbarred that in. Anyway, Tesla, of course, big mover in the after-hours session, down about 4 or 5%. Elon Musk, of course, and this is an important story, warning of a few rough quarters ahead as tariff costs increase and bite into demand. That's after second quarter sales plunge. Get this, 12%, the worst drop in at least a decade.
We probably could have a few rough quarters. I'm not saying we will, but we could. Q4, Q1, maybe Q2. But once you get to autonomy at scale in the second half of next year, certainly by the end of next year, I think I would be surprised if Tesla's economics are not very compelling.
Let's bring in our EV supply chain reporter, Danny Lee, to break down these earnings for us. And you kind of heard in this call, right, that it's almost like there's still some heartbreak from this breakup with President Trump when you talk about the impact on tariffs and the impact from this big, beautiful bill as well on Tesla.
You hear how Elon Musk is very downbeat. He's very kind of flat in his call with analysts, which only ended a couple of hours ago, right? And this was this second quarter a pretty. This is probably as bad as it gets, frankly, for now. Maybe it gets even worse. We are going to see another difficult couple of periods ahead, as Elon Musk warned. And this is just as Tesla transitions from just being an EV-only focused company into one they want to clearly upsell autonomy, robo-taxis, robots. And so it's the earnings story around the EVs which continues to drag down the company, whilst all this future-looking stuff which gives Tesla even more value, which has yet to be fleshed out in detail, still hasn't really shown up in any kind of earnings or any kind of detail, which analysts really want to hear about more. Yeah,
the market tends to get impatient, really, when it comes to these things. Anything on the Asia-Pacific?
Well, there's only one thing on the Asia-Pacific that Elon Musk raised, and that was this roadblock to getting more autonomous testing done in China. So that's going to be a key thing as they separate out what they're doing in the rest of the world and in China. And so therefore they're still facing some roadblocks to getting that testing launched and to try and catch up to some of its peers. And even it's a bit of a surprise that more of Asia wasn't mentioned because of what they've just launched in India recently. They've expanded, and this India, a new market for them, could help them drive more sales where they have been flagging in other parts of the world. So you've expected maybe Musk to talk more about some of these new and emerging markets, more in the Middle East, more in India, but we haven't quite heard that as he tries to focus on a lot of things to try and get Tesla back on a better footing.
All right. Danny, thank you. Danny Lee there, our EV supply chain reporter. And of course, we're going to get Beth Kindig from IO Fund joining us to break down those earnings further in the next hour. Another earnings news, Alphabet shares gained in late trade after second quarter sales beat Wall Street estimates. It's also raising capital spending this year by $10 billion, with CEO Sundar Pichai citing rising demand for cloud and AI services. Google is weaving its flagship AI model, Gemini, into its product portfolio as it confronts competition from Meta and Microsoft. IBM shares slipped, though, as it reported weaker than expected sales in its closely watched software segment. Sales for the unit grew 10% on year to about $7.4 billion, which fell short of the average analyst estimate. Evercore ISI says investors are likely to question how durable IBM software growth will be in the second half.
Okay, let's stay on tech. AMD says the chips it buys from TSMC's Arizona plant actually cost up to 20% more than those actually made in Taiwan. The CEO, Lisa Su, actually spoke to us exclusively at an AI event where President Trump promised the U.S. would win the global race in tech. She told us that a White House plan is crucial to ensuring access to resources.
I think the AI Action Plan absolutely helps this notion of bringing up the resources that are necessary, whether it's regulatory or power or, just ensuring that there's a view that this is a priority. And if it's a priority for the administration, it'll be a priority for the industry. And, it kind of coalesces all of the aspects that are necessary. So it's still hard work. I don't want to say that, we can do this, quickly. It's still multi-years.
But you will move some chips from Arizona this year, I think you said.
Absolutely. We're going to start manufacturing this year, and we're going to add to it as we go forward. One
of the things you addressed on stage was the idea of the relative price comparison for a semiconductor made here in the United States versus abroad. There is a marginal degree of greater expense. I think you said it was less than 20%, more than 5%, somewhere high double digits. But if you are building the broader high-performance compute system in the United States, does it matter? I mean, how do you approach the sort of economics of it? I think the economics of it are we have to consider the just resiliency in the supply chain. I think we learned that, frankly, Ed, from the pandemic. The idea that you think about your supply chains not just by the lowest cost, but also about reliability, about resiliency, and all those things. I think that's how we're thinking about U.S. manufacturing. And yes, it will be a little bit more expensive. Frankly, some of the work that has been done to encourage semiconductor investment has been helpful. But when you really average it across everything else that you need to build this computing infrastructure, I think it's a very good investment for us to make to assure that we have American manufacturing and resiliency. The AI action plan will be followed by action, one imagines, executive orders from the president and other pieces of specific policy. What is left to do, to your mind? What is it actually that needs to be enacted, either from a supply chain point of view or your ability to sell your technologies around the world? Well, what I really like about the AI action plan is I actually believe it's quite actionable. So there are lots of things in there where when we look at it, it's a perfect blueprint for public-private partnership. And, we're going to be active with the administration to try to help shape some of those conversations about, what should be exported, what an open ecosystem looks like, how do we ensure that AI for science is front of mind. We're very active with the Department of Energy on, the entire national lab infrastructure, which can really help accelerate AI in the country. So, we're ready to go.
That was the AMD CEO, Lisa Su, there. Of course, there's much more ahead on the big tech results as well. We talked about Beth Kindig from IO Fund, the lead analyst there. She's going to join us about 20 minutes with her views on Tesla and what to watch out for this earnings season beyond the AI hype. Plenty more ahead. This is Bloomberg.
Right, welcome back. So this rally that's still taking place, as you can see, 6-day look, almost looks like my heart rate every time I get stressed here at work, which is probably what you're going to see anyway if we do an ECG at the moment. But yes, anyway, 4% to the upside. The big driver today is really when you look at tech, for example. SK Hynix reported blowout earnings, great guidance, excuse me. When you look at what's happening in South Korea, and of course that's lifting that tide as well, you have, of course, this renewed vigor in the Japanese market, all things equal, this is what you're getting. 6 days, the longest win streak going back to the start of the year. In fact, so much so, and so quickly enough, that when you look at the longer-term chart on price, so we're going to put this at the very top of the next graphic coming up on your screens, and the bottom's actually going to show you a gauge of momentum, the 14-day RSI. It's actually now at 80, the highest level going back. You could make the argument, highest going back to the pandemic. So, question mark, are we actually due for a consolidation across this equity market, which has done, as you can see, exceptionally well, and we're, I think, within about 2 or 3% of that high, Yvonne, that we hit back in 2020. But yeah, pay attention to this. That's not a move you normally see. That's not a level you normally see us stay at for quite some time, especially when we see an 8 handle as far as that's concerned.
Yeah, certainly that's one thing to watch here, signs of maybe overheating across the Asia-Pacific. One thing, though, what's really driving this equity rally, of course, still remains the tech space, growth stocks and the like, right? And we had another sort of catalyst here today with SK Hynix coming out with their earnings. So this is after we saw record earnings. They plan to quicken the spending on advanced memory chip capacity and just really reflecting the surging AI demand out there and a drive to stay ahead of its rivals. So SK Hynix is up as well at 1%. That's kind of lifting the likes of Taiwan Semi. SMIC is up some 2%. Even Samsung's catching a bit here this morning, but Tokyo Electron heading the opposite direction. We're going to have a lot more on the way in the next hour of the China Show. This is Bloomberg. Almost like a picture. Welcome back to the China Show. A look into Hong Kong, the harbor this morning, and it's sunny skies. It's cleared up after this typhoon, and it looks like things are pretty still sunny when it comes to Hong Kong after we did see those H-shares reach the highest level since October of 2021. Hong Kong has already been hitting those milestones already, but certainly we talk about the onshore market. That's where you're seeing a lot of that catch up, right? And Winnie Wu just told us, yeah, there's a lot going on there too that we shouldn't overlook too.
Yeah, people might be trading pairs there as the gap between the valuations reached some extreme recently, and maybe there's a bit of catch up on closing up there of that valuation gap onshore. And let's see what turnover looks like today. Speculation also on what southbound connect and what other things investors can do onshore, taking their money here in Hong Kong. But yeah, the turnover has averaged 1.8 trillion over 2 days, which is quite something. You don't normally see that on this market. Nikkei 225 is now up 2%, so that now puts us really within striking distance of a fresh record there. The Topix, I believe, is already there. Taiwan is, I guess, indicative of the tech rally that's been going on. NASDAQ futures shrugging off the weakness we're seeing across other after-hours constituents. We'll talk about Tesla in a moment, just alluding to that as well. Okay, going into today, other things taking place. You have an ECB decision taking place later today. Most economists, if not all, virtually all, with the exception, I think, of 1 or 2, do expect things to largely remain unchanged. Euro stock futures 1.5%. Wow, what a move there. So it is a risk-on rally here. And there's also a CGB sale today. We should get more details on that this or next hour. 1, 5, and 30-year bonds. And of course, we're also looking at the Thai baht here too as well.
Yeah, it's interesting that you're seeing this continued strength into the currency after what we've been seeing, a lot of inflow certainly into Thailand as well, a lot of optimism around trade. So the baht did rise, or is rising, the highest since 2022. We just got this line also from the Thailand army reporting about how Thai and Cambodian troops clash near a disputed site there. This on the back, what we've been hearing, there's some border disputes that have been flaring up where it's led to both sides to recall their ambassadors as well. So we'll continue to watch that one in Thailand at the border here today. But in terms of top themes, it's still about trade, right? The fact that we heard from the Philippines ambassadors, the U.S. saying, look, 15%, not 19%, I should say, is not the final say right now. They're still looking to negotiate into that deadline. And he said, look, the president said 15% is probably the floor. They're going to aim to head there. And I'm sure many nations are going to do that with just, 6-7 days ago before the deadline. Yeah,
well, Japan got it, right? So,
yeah.
But Japan does, of course, wield a sort of bigger influence.
Europe might try. We'll see.
Europe might try. And speaking of Europe, right, this hour as well, well, today, of course, it's Europe and China. That's also going to be very much in focus. You have President Xi Jinping, of course, set to meet EU officials. And that specific economic relationship looks kind of tricky. Like it's seeing better days. Let's see what kind of progress we see there today.
I mean, Europe has sanctioned some of the banks over what, China's role in facilitating trade with Russia. You have everything that goes on with EV tariffs as well.
Rare earths.
So it's really tough to see what could be tangible and what could be deliverables in this summit, especially at a time when you have China and the EU discussing trade deals with the U.S., right? They don't want to rock the boat just yet until maybe they get some sort of framework with Washington so far.
Yeah, we'll get to the latest on that in a moment. In fact, later on in the show, in about 40 minutes, the EU Chamber of Commerce in China will be joining us to talk us through that. While we wait for that, later on, President Trump, on our top story, there we go, has suggested that he will not go below, as we were just pointing out there, 15% as he sets so-called reciprocal tariff rates, indicating that the floor for levies is actually rising. You have major economies, including India and the EU, still scrambling to secure a trade deal that's ahead of this August 1 deadline, just about a week away.
We're going to have a very, very simple tariff for some of the countries. There's so many countries you can't negotiate deals with everyone, so we'll have a straight, simple tariff of anywhere between 15 and 50%. A couple we have 15 because we haven't been getting along with those countries too well. So we just say, let's pay 50. And that's the way it is.
Let's bring in Mark Cranfield, our MLI strategist, joining us out from Singapore. So it seems like we're seeing animal spirits come back on the back of some of these trade deals, Mark. But as Dave has mentioned, you take a look at some of these equity markets, and we're seeing signs of maybe overbought territory now. How should we be looking at the next few days and weeks when it comes to risk assets now? Is it time for a breather?
There's certainly some risks around any trade deal with the European Union because there seems to be an assumption being priced into the market that Europe will get a similar kind of deal to Japan, so something around the 15% range on the tariffs. Now, if they don't, if it fails or if it's delayed much longer and it looks as though that tariff level could go higher, that would certainly be an issue for markets to deal with because they're not really expecting that. So they'll be watching very closely how that European deal plays out. They'll also be watching what happens between Europe and China as well. But much more importantly is whether Europe can secure such a favorable, or what is seen as such a favorable deal as Japan, because that would really disrupt markets, especially European equities, if they can't achieve that. So you would see some pretty high volatility around there for the euro as well. The euro is performing very well in the last few days, again on the assumption that Europe is going to get a good deal here. So there's a lot resting on that. The European decision, as you say, ECB, nobody expects them to actually change rates today, but their outlook could certainly be affected by what they see coming in terms of the trade deal. So you may see them sounding a little bit more hawkish. If they think that deal is coming through, ECB could sound a bit more hawkish than expected tonight when they start speaking after the minutes are out. They've also got the Fed meeting next week, and we've already heard the Commerce Secretary Lutnick weigh in today, another person saying that the Federal Reserve should lower interest rates more quickly, putting more pressure on Jerome Powell. So certainly next week you've got not only these old deadlines of August the 1st coming up, you've got a Fed meeting as well and a Bank of Japan decision as well. There's plenty up in the air. But certainly in the very near term, the EU trade deal is probably the most significant thing on the table for traders.
Mark, maybe just to also ask you about within this equity market rally in the region, Japan obviously has seen a revival from yesterday going into today. The Topix index, I'm looking at volumes, 33% heavier again than usual for this time of the day. What's going on in Japan? Is there still some momentum we can chase there?
If you're looking at catch-up plays, rotation, I mean, Japan just stands out by miles across the European markets. Even after yesterday's huge rally, the Topix Nikkei index, they're way behind the kind of gains we've seen this year for Kospi, Hang Seng Index, H shares. It's so far behind. People obviously were sitting on the sidelines waiting to see what would happen for Japan. Money starting to pour in now. Those trading volumes that we saw yesterday were the biggest since April. That's very encouraging for new money, which is coming into the market. You want to see that kind of momentum continuing. And the fact that the market's still in the green today is another very good sign. But if you're a big portfolio manager and you've had a very good first half of the year based on Hong Kong and Korean equities, why wouldn't you be switching some of that money into Japan, which is a clear laggard? Now's got the trade deal behind it. The yen, although it's slightly stronger today, is still relatively weak in the big picture scheme. So the yen favors the Japanese market as well. The high yields in the JGB is pretty much priced in anyway. Bank of Japan is clearly behind the curve. They probably will raise interest rates again this year, but at such a slow pace, it's hardly going to make any difference to the equity market at all. So all the things are going into place. Even the political situation is getting a bit clearer in Japan as well. So from an external point of view, Japan suddenly looks a lot more interesting to global portfolio managers, and there's plenty of catch-up room with the rest of the markets.
Mark, you mentioned that PBOC fix today. You called it spicy. Tell us why.
Well, if you again, they've pushed the fixing below 714 for the first time since early November, which, if you look at the steps they've taken over the past few days, these are pretty large moves in the context of the PBOC, who normally only change the fixing by just a few pips a day. And you can see some of this is probably an olive branch to the European discussions that are going on with the trade here. Because in the background, the driver of the PBOC fixing is the euro. The euro-yuan cross is near multi-year highs. Euro is super strong against the yuan. And by lowering the dollar-yuan fixing, they're helping to moderate some of those moves. If the PBOC did nothing, euro-yuan will be at all-time highs. And that wouldn't be a good signal to the trade negotiations between China and Europe. So really what the PBOC is doing here, they're giving a signal to Asian currencies. Yes, we're in line with you. We see further strength across the board there. But they're also reaching out to Europe as well, saying, look, we're not trying to make things too difficult for you. We're going to keep the fixing going in a direction which means that the euro-yuan won't get too much stronger for the time being. That may help the negotiations go a little bit more smoothly.
Mark, thank you. Mark Cranfield there out of our MLive team over in Singapore for us. As we head into this break, MSCI Asia Pacific now highest level here in about 4 years or so, longest win streak in since the start of the year. We're counting now 6 straight days. Because of that, because of other things taking place, Japan, as you can see, is now up 2% going into the last 20 minutes of the morning session. Plenty more ahead. This is the China Show.
Well, Tesla CEO Elon Musk has told investors to prepare for what could be a rough few quarters ahead after sales in the prior period fell 12%, the company's worst result in more than a decade. He also spoke on the earnings call about regulatory challenges in China.
And then we also have some regulatory challenges in China, which we're hoping to unblock shortly, because we also cannot provide supervised FST in China currently, but we hope to unblock that soon. And that's another major. It really is the single biggest demand driver.
Let's bring in Beth Kindig, lead analyst at IO Fund, of course, which runs tech-focused stock portfolios. Beth, good morning from the Asia Pacific. Thank you for joining us. Lots to get into. I was hoping to start with Tesla, and it's I think one thing that did stand out, just as we were hearing that soundbite, is just the tone coming through out of Elon Musk, who normally doesn't, exude that sort of low level of confidence. And I wonder how you're looking at the company itself currently, given where the stock price is as well, just to consider that too.
Sure. Good to see you both again. There were puts and takes tonight with Tesla's report. On one hand, there was a quarter-over-quarter improvement in the margins. There was actually a 4% rebound in the average sales price, so that was a positive. But the uncertainty of what lies ahead is really weighing on the stock after hours. Not only did we hear some of that regulatory issues in China, but inventory was up 21%, deliveries were down 13%. That would point to, demand issues and an oversupply. And all of that is ahead of that EV credit expiring at the end of September. So again, the stock is down after hours, and deservedly so, considering the uncertainty of what is coming next quarter.
And I mean, how you look at the stock is really kind of determinant of how you think it's going to perform. Is it actually, the core business is still an automaker? Or do you look at this company and the innovation that you're seeing? Is it an AI? Is it a robotics juggernaut, right? I mean, how should we actually look at this company now, Beth?
Yeah, right here, right now, this is a car company. I don't think that can be, there's nothing that proves that R&D around AI is monetizing. And that is really what is important for tech investors, is broadly even speaking, who is monetizing AI right now? And that's really important considering the tens of billions being poured in to, whether it's AI data centers, whether it's training models, there's tens of billions being poured into that. And until a company can put up material evidence of the ROI on that CapEx or that R&D spend, for me, when we're talking about Tesla, it remains a car company. For example, they were expected to deliver 2 million vehicles this year. They've delivered about 700,000, 750,000. They're about 1 million short, 1.1 million short. And until that's all cleared up, I think the AI story, again, that we haven't seen monetized yet, is in the backseat.
Yeah, I guess to the point you just made there are other options. If you like AI, there are other options beyond Tesla. And this earnings season, I'm looking at Alphabet, for example, and what looks to be a good problem to have, they're running into some issues scaling up CapEx and getting products to the market. How are you looking at Alphabet these days, Beth?
Yeah, Alphabet, I mean, this was a hotly debated stock going into the earnings, because the question was, how is search monetizing given the time being spent in apps like ChatGPT? They did clear that hurdle tonight. They accelerated search. So not only AI is actually helping internally there with their own, with their own apps, their own leading segment. And then when you look at Google Cloud, that's also accelerating. But again, we're seeing some weak price action because it goes back to the fact that there are tens of billions being spent. Alphabet raised their CapEx to about $85 billion compared to about $12 billion that they're seeing in revenue on Google Cloud. So there's definitely a gap there between what's being spent and what these companies can report. My favorite actually would be Microsoft. I think Microsoft is in a very material way saying we have ROI on that CapEx.
Yeah, it's interesting, Beth, right? You look at the after-hours trade in Alphabet, as soon as they mentioned that CapEx figure, it basically killed that after-hours rally in the stock. So how are investors basically still running out of patience about big spending when it comes to AI now?
Yes, and now I got my start in Silicon Valley. I was there for over a decade. And the way Silicon Valley does it is very different than Wall Street. Wall Street wants to see those profits immediately. And really, this is going to take some time. I don't doubt that these companies in the long run will be winners. It's going to take some time. And I think there's better ways to play it, right? We look at the $85 billion that Google is spending. Well, who is that going to? It's going to AI hardware. And I think, again, right here, right now, that's a much better way to position.
Beth, and to the point that you just made too, like recently, when I say recently, let's call it the last 5 or 6 weeks, AI has again become not just the biggest part of investors' mindset, also the biggest driver of returns. Overall, you look at a Mag 7, how are you viewing valuations at the moment?
Many are stretched. I think we can see them lower. In fact, my firm is rotating away from those stretched valuations and favoring some of these AI hardware plays where, because they're growing so rapidly, there are a couple of AI hardware companies growing 300%. Again, because this CapEx just flows straight down the line. And so to me, it's rotate more to those hyper growth AI hardware stocks for now.
Can you tell us what you won't touch and what maybe you think you could rotate to now within that sort of universe?
When I look at something like Meta, Meta historically has not traded this high, and Meta has participated in massive trends such as mobile when it became a native app and social media and ads, and it's never traded this high. So we are personally rotating out of Meta, and we really favor things like Astera Labs and Credo, which are both AI hardware stocks that in the networking layer that serve, they supply NVIDIA. They also supply custom silicon, and all those tens of billions, it doesn't matter if it's coming from Google, Meta, Microsoft, Amazon, they filter down into that supply chain. It's just a much safer bet, in my opinion, right now.
Beth, it's great to have you. Didn't even talk about NVIDIA today. Beth Kindig, lead tech analyst at AOF. I'm going to get you back. We've got plenty more ahead. This is Bloomberg. The U.S. Commerce Secretary has described China's exit ban on a U.S. government employee as outrageous behavior. Howard Lutnick also spoke to us about the decision to ease restrictions on H20 AI chip sales if China delivers more magnets.
The H20 was the third best chip in the world, and now it's the fourth best, right? Because the Blackwell is the best. There's an H200 and H100, so an H20 is the fourth best chip. And I think the president has decided that if things are going well with China, that they can buy them. So I think that decision's been made. We are putting on the licensing mechanism, and we are getting that going. But the president has decided that the Chinese can buy them, but that's in a balanced way with the Chinese delivering on the deal that we made with them, and they're delivering rare earths to American manufacturers.
So when you sit across from your Chinese counterparts next week, what do you plan to discuss with them? Is loosening export controls, more export controls on the table?
I think what we talk about is there's a line, right? Below the line, we are giant economies. We should trade with each other, right? They want to buy our produce. They want to buy our vegetables, right? They don't grow everything. They don't have the breadbasket of America that we have. So they want to buy those products. And you know what? There's lots of things that they make that we want to buy, that we want inexpensive things on our shelves. So let's talk below the line. Let's open the market better in China and let us sell more things in China. And then at the line where we're competitive, where is that line where above that line, they're not going to sell us their hypersonic missiles, and we're not selling them our best chips. Those two things are not happening because they're a competitor. They are a competitor. And what we're really going to discuss is where's that line? Are the H20s above the line or below the line? That's really nuance, and that's discussion. But of course, would we like to buy baby clothes that are inexpensive? Of course we would. That makes perfect sense. So let's open the market down here, right? We're never opening the market up here. And what do we discuss? We discuss that line of what's over it and what's under it. But do we want more of this? Them selling it to us and us selling it to them? The president and President Xi from China agreed that they would like to do more business there. So we're going to talk about opening their market more for things that make sense to open it. And we're really going to discuss the areas that maybe we should really be addressing. Is that yes or is that no? One area,
I just want to finish on this. I'm curious if you're going to address directly, because it's the Commerce Department. An employee of yours is facing an exit ban right now from China. Do you have any update on this?
It's unbelievable, right? So he has, there was an employee of ours, he's a Chinese national who was working in the patent office, and he went home and he was arrested, and they're holding his passport. I mean, so I give that to the State Department, and the State Department deals with that, but it is outrageous behavior.
There you go. That was the U.S. Commerce Secretary Howard Lutnick with Anna Maria, of course, Anne-Marie Hordern in the U.S. A quick glance at markets. So two things to tell you about right now. CGB market, yields are on the way up. Steeper curve, as you can see. The 30-year yield, and we'll get the bond auction in a moment. Of course, a couple of more details there. Also worth pointing out, though, is the economic surveys out for July. This is a survey we do on a monthly basis, and it does show a slight uptick as far as the growth expectations are concerned, consistent really with the data that's come through recently.
Yeah, I was interested, looking at my inbox, I believe it was ANZ that talked about this whole China reflation strategy. We're actually talking about reflation. Given what we've been seeing with anti-involution, this dam project, so that certainly is lifting the likes of some of these commodities and maybe can lift China out of deflation, right? That's the goal, that's the dream. Certainly how it happens there, Winnie Wu from BofA did mention, it is a 3 to 5 year sort of horizon you got to think about when it comes to that. That's why we're checking some of those miners there today as well. Putting more ahead, this is Bloomberg.
I think it's very important to know that 15% for Japan for reciprocal tariffs for autos, that is a different kind of deal, but because the Japanese proposed a very innovative solution.
U.S. Treasury Secretary Scott Bessent, they're speaking about that trade deal with Tokyo, and it's almost 11:30 a.m. there. Market's hitting that lunch break, and we continue to see this rally getting fired up in Tokyo. Take a look. Volumes are concerned. They're surging once again here. And it's interesting, right? I think it was late afternoon, Dave, when we heard from the Prime Minister, Ishiba, with a very interesting call. He says he's vowing to remain as the leader, despite all the speculation, these local media reports of him maybe possibly resigning in a few weeks.
Yeah, it's interesting how the news lines evolved this time yesterday, right? So it started with him not commenting on his future when they were talking about the trade deal. Then you had 1 or 2 local reports coming out, one giving a timeline, and August, another one coming in and say it was going to happen soon. And then it's about face as far as that's concerned. But I guess suffice to say, there tends to be fire when there is smoke. I think it's something I would say, but certainly it is something to watch going forward, and really what that means for not the trade deal, but domestic politics, right? It just underscores this reflation story, which is a good thing for markets, but domestically, of course, there needs to be some way to address that too. We're looking at markets there. I think we just showed you that. Can we show that again, please, if we can? So the Nikkei is actually very near a new record now, following the Topix index, which I think hit that milestone.
And basically what's happened is, right, like if you sort out the winners and losers, there's a great piece out from our team in Tokyo about how this Japan trade deal has basically moved some of the losers back into being winners and vice versa. So like you look at car makers, for example, machinery makers and banks are now seen as winners of this deal. And we obviously saw that relief rally in the autos yesterday after we heard that those U.S. tariffs have been lowered. On the flip side, you're starting to see defense-related stocks, domestic demand-linked shares, real estate firms, for example, are now heading the opposite direction.
Yeah, I mean, higher rates, what's that going to do? As far as that's concerned, right?
Yeah.
And I think the one big loser, quote unquote, recently is our colleague Sherry, who's been exhausted covering all of these things for us. There, of course, we've had to drag her into the studio last minute several times yesterday. Yeah, well deserved, at least not for now, Sherry. But if you're listening, stay tuned. We might need you at some point soon, particularly when the Nikkei actually hits that new record here, 42,000. I'm sounding you out already. Start to mic up. Okay. While the Japan rally's been taking place, China's also been doing very well. The market's been rallying there. There's a lot of conversations around how do I gain exposure to China? Is it the ETF space in Hong Kong? When you look at onshore markets, certainly Hong Kong has been the primary destination. ETF connectivity has really been a big topic of late, especially here in the region.
Yeah. And Yvonne just introduced its latest ETF on the Singapore exchange. And now joining us now is Fan Bing, Deputy CEO and CIO of Yvonne Management Singapore. Fan Bing, it's great to have you. Can you tell us a bit more about behind this ETF, the timing of it, and why Singapore in particular?
Hi, it's a good pleasure to be here. Thank you for having me here. My name is Bing Fan. I'm from Yvonne Management Singapore. Regarding the timing of Chinnex ETFs, so we do believe Chinnex index investment value has been recognized by many investors today, given the year-to-date performance. And going forward, we do see the great potential for, further investment cases to be reviewed by institutional and retail investors. Thank you.
Okay, Fan Bing, this is David. The other question I have is why the Chinnex index specifically?
Sure. So Chinnex Index has been launched with 15 years of history. Chinnex is focused on innovation and growth-driven companies. And for Chinnex itself, it has some special listing rules. So first one, it's a first board adopted the registration-based IPO system back in 2020. It also have several features, like they allow the pre-profit company to be listed. They also allow the dual share classes, and they also have a negative screening list to making sure the index is really fostering the innovation and technology-driven industries, as well as the traditional industries, integrating with the innovation elements. And so for Chinnex itself, it has more than 70% of the index value coming from the new economy sectors. But within the 70% itself, it also have a rather diversified focus on not only just the hard technologies, but also the digital economy portion of them. So meaning Chinnex is growth and innovation focused, but in the meantime, it's also diversified within the new economy sectors.
Yeah, it's interesting, right? Because certainly that's where most of these companies list, but I have to say they're not really big household names, which overseas investors might not really be attuned to, right? Maybe they'd rather look at something like the HS Tech, for example. I'm just wondering, what sort of overseas appetite do you actually see for some of these companies now, Fan Bing?
Based on the conversation we had in recent months, we do see a mismatch between the presence of China in terms of the global industrial chain and the allocation of the global asset allocations portion of China. And I believe the mismatch between those two reflects some of the concern of a China economy. Looking forward, we do see this gap will have a great potential to be narrowing down. And for coming down to the allocation to China technology portion, the Chinnex itself does provide a better opportunities or access to accessing the high growing and growth industries from the world's second largest economy, focus on artificial intelligence, biotech, and also the hard technology driven industries. For those, I think Chinnex itself and also the beta solution products around Chinnex, providing investors globally and domestically a chance to enjoy the dividend from China's economy and technology growth stories.
Yeah, and in this case, via Singapore, of course, where you are. And I wonder, do you have any projections or estimates how much flow in AUM you expect to see here?
We do tracking the monthly flow for global asset allocation to China closely. And Singapore is one of the most important global asset allocation hub. So far, I mean, in the past couple of weeks, China markets was doing quite strong, and we do see the interest from both the institutions and the retail investors coming into the China story investment stories. For the like in the midterm or long term for the inflow, currently the asset allocation flow for China is relatively still underweight. But ever since first quarter of this year, we do see the underweighting has been narrowed down. And this narrowed down the money flow, quite a few of them is using the ETF as the accessing tool. Hence, we do see a strong interest for China-themed and focused ETF, both locally and globally around the globe.
Yeah, thank you so much, Fan Bing. If ever you're in Hong Kong next, do let us know. Of course, let's bring you here into our studios here. Hi to the team at eFunds there. Fan Bing, Deputy CEO and CIO at eFund Management Singapore, on the latest product and, of course, what's going on there with the cross-border ETF connectivity between China and Singapore. Right, coming up here, more on today's meeting with the EU and Chinese leaders in Beijing. The EU Chamber of Commerce President will be joining us to discuss the challenges facing relations and maybe greater and more important context on these meetings taking place. In fact, maybe even right now. That's coming up soon. And as we go into the break, take a short break, we're looking at benchmarks. And you know what? We reversed the early weakness. We're now higher again on the Hang Seng Index. More on these lines coming through here out of CCTV. And it seems to be looking to address the excessive competition. China's market regulators looking to rectify excessive competition. That's according to CCTV. Also in my inbox, just dropping right now. So we had a conversation with BofA. Morgan Stanley's out with its own note. And yes, go ahead, Yvonne. Yeah,
we just got some lines from CCTV as well that now President Xi is going to be meeting the EU's von der Leyen and Costa, of course, as we see this summit kick off as well between the EU and China. So a lot's going on. We'll get you more coming up. This is Bloomberg. All right, we are just getting those lines from CCTV, and it has been confirmed that now we are likely to see President Xi and EU's Ursula von der Leyen to be speaking later on today in this summit, along with the European Council President Costa as well. So we're talking about high-level talks, right, from leaders from the EU as well. We'll be meeting with the Chinese president today in Beijing, the first in-person summit since 2023. Joining us now is someone who will also be attending some of these summit meetings, Eskelund-Hansen, president of the EU Chamber of Commerce in China. He joins us live from Beijing this morning. Jens, it's always great to have you. What's going to be the message to European and Chinese leaders in your meeting today?
I think there'll be several. From our part, the main focus would be on trade and market access. We are concerned of what we are seeing in terms of trade imbalances growing ever wider, and we continue to see continued restrictions on market access for European companies. A few months ago, we released our annual business confidence survey, and 67% of our members told us that they have been losing business opportunities because of market access restriction, and that number is simply too high, and we need to bring that down somehow. And then, of course, similar to Chinese companies, we are struggling with involution, with overcapacity, with persistent deflation. We have now had 32 consecutive months of producer price deflation, and that is something that is harming us as much as it's harming Chinese companies. And of course, on the positive side, in particular on the decarbonization agenda, there's a lot we can do together, and we all recognize that China will be a critically important enabler for Europe to reach its ambitious climate goals.
On market access, Jens, I'm curious, what would your advice be to European leaders who will have an audience, of course, with top Chinese officials? And is it realistic to expect progress on that front at this specific meeting, of course?
Yeah. I don't think that any of us are too optimistic in terms of any sort of grand agreement being reached, and I don't think that this is really what we should aspire to. I think the backdrop of this meeting here is that we have the 50th anniversary of bilateral diplomatic relations between the European Union and China. This is a relationship that has created immense value for both China and for Europe. But maybe now, when we have the anniversary, there is an opportunity, a time for us to reflect on how do we ensure that we have a relationship going forward that continue to deliver benefits from both sides. And what we're seeing right now is this increase in trade tension and this perception, in particular in Europe, that the benefits of the relationship is no longer being distributed in an equitable manner. And for us, the important thing is that both sides realize that we are a little bit on a burning platform, and that we need to have these serious conversations about how sort of do we recalibrate so that Europe can also see that it makes sense that we continue to engage at the very high and very deep level that we are doing today. Specifically, when it comes to market access, we have seen on the one hand that, as the Chinese government has mentioned in several statements, that there is a movement in some industries towards wider opening, towards reform. But we also see that there is an increased focus on security, on localization, on import substitution, on self-sufficiency, on self-reliance. And these are some of the things that worry European companies, and where we see restrictions are popping up related specifically to some of those localization requirements.
And Jens, this is coming at a time, you mentioned the backdrop, where the EU and China are both trying to at least confirm some sort of trade deal with the U.S. How do you see those negotiations impacting what happens in between the EU and China today? Because some would say maybe they're unlikely to rock the boat because they're waiting to see what D.C. says. Or does that give more of a reason for the EU to be more emboldened to be firm on China?
You know, there's no doubt, of course, that what's happening outside of the bilateral EU-China relationship is impacting the EU-China relationship. But I think one of the challenges over time in the relationship has been that the relationship between Europe and China has also always been seen through the lens of the relationship with the United States. And I think we need to recognize, if we are to move forward, that there are issues that are specific to the EU-China relationship, and that we need to have a sharp focus on these, for example, in terms of deindustrialization in Europe, and in terms of access for European companies in China. So yes, there will be an impact, but I think it's very, very important that we do not lose sight of the fact that there are issues that are specific to the EU-China relationship, and we also stay laser focused on these issues as we go forward.
Do you see those issues being resolved over the next year?
Well, I think that's the question that we all are waiting to see. The most urgent issue right now, obviously, is related to export controls in China, rare earths and magnets. And that is something that has delivered a blow to many European companies, and also has sort of shaken the confidence in China as a reliable and predictable supplier. So one thing that we hope is that this is being addressed at this particular summit here. So we have this certainty, that we have this clear line in sight, that manufacturing, that European companies will not incur unnecessary losses because they don't have this access. And we think this is one of the things that can be done to restore confidence, that is, that a model is found where sort of a more general licensing scheme is devised that allow business continuity for European companies. That is one of the things that would help to strengthen confidence going forward.
Jens, you mentioned about producer prices and talking about, you know, how long we've been staying in deflation. Some of the anti-involution sort of efforts is also maybe hurting some of the companies that are part of your members as well. How difficult is business now for European companies operating in China, and how important is China still as a market for some of these companies?
It's a really, really good question. Again, in our business confidence survey that we just published a few months ago, we saw that 70% of our 1,700 members are now telling us that they're getting similar or higher profit margins outside China compared to inside China. So you can say from that perspective, maybe China's attractiveness is eroding a little bit relative to other countries. But we're actually seeing an interesting phenomenon. More than a quarter of our members are actually increasing their onshoring in China. And we think there are several reasons for that. One reason is, of course, that onshoring in China is a way to de-risk your in-China, for China supply chain. You minimize sort of your vulnerability for your China, in China, for China supply chain if you sort of reduce your dependency on outside supply chains. But the other factor that I think is very interesting, and where I think Europe also needs to pay attention, is that we see multinational European companies. They obviously need to compete against other companies, and the way that you win in the market is to have better products at a lower price. Now, what we see is, in order to have the best product at the most attractive price, you obviously need to source the components where you get the best components at the most attractive price. And in many, many cases, that is here in China. So we see actually in many ways that European business is becoming not less dependent, but perhaps more dependent on China. So actually more European companies onshoring in China.
Yeah, Jens, that's interesting. And I want to ask you, among your members, is it now almost a conscious or deliberate effort to, and is it possible in their view to effectively make their supply chains in China self-contained and self-sustainable?
We are beginning to see, in particular, for companies that are in China, for China, to have independent and self-sustained autonomous supply chains. And this is, of course, another area where we see geopolitics playing a role. There is an emphasis, in particular in the United States, but also increasingly in China, on having entirely managed supply chains within the borders of the country. It's one of those things that unfortunately are creating inefficiencies for our members, because we are operating global supply chains, and if you need to invest in having entirely separate supply chains in China, it sort of reduces your ability to achieve economies of scale and utilize capacity outside of China. So it's actually not something we welcome. But we think many companies, because of these pressures, are feeling forced to begin to silo some of their supply chains. We see it, for example, within automotive.
Jens, thank you so much. We'll let you go. I know you have a short trek to make there to the Great Hall of the People for some meetings, we believe. Jens Eskelund there, thank you so much, President at the EU Chamber of Commerce in China. Subscribers can watch us live, or if you missed some parts of that specific interview, you can scroll back a little bit on the TV function, TV Go, dive into any of the securities or functions that we talk about here on the show, become part of the conversation, send us instant messages, check it out, TV Go. This is Bloomberg. Right, welcome back. U.S. futures are doing this. Okay, so interesting. We just got some reports, I believe, that a former property man who's not a president is headed to the Fed on Thursday. That's President Trump, of course, maybe to, I don't know, do an ocular of the renovations.
What's been sort of the crux of this sort of saga between Trump and Powell is this whole criticism about the central bank's renovations, right? So he has been demanding for some sort of visit to really take a look at this renovation project himself. So Thursday has been the confirmed time. I think they were trying to do Friday, but then it was rejected because the Trump has to go eat with some senators that evening as well. So we're now confirming that that visit is happening, right? So whether we see what happens and what comes out, maybe a little bit more fireworks there when it comes to this criticism that the president has with Jay Powell for not cutting rates, basically.
Yeah, okay. So also, so on top of that recce, we're also looking at an ECB decision that is largely expected to remain uneventful, but it's really in the guidance and the change on the outlook, which might actually give us something to talk about, given everything that's going on or what hasn't been resolved it as far as the trade negotiations are concerned. That comes up, of course, later today. We're now up 6 days here in the Asia Pacific on and as you can see, we've shaken off the early cobwebs here on the Hang Seng Index.
Yeah, 4-year highs. We extend that rally once again. You're seeing 4-year highs in Asia Pacifics as well. So you take a look at how the stocks are doing on the MXAP. We're up session highs of 1% here right now. Are we due for a breather? We've been talking about the RSI. They can look a little bit overheated, but it doesn't seem like that's the case here today. This is Bloomberg.